For years, Washington operated under a simple assumption that no matter how tense trade negotiations became, no matter how aggressive American policy grew, Canada would ultimately have no choice but to comply. Canadian agriculture, after all, depended on American infrastructure. Grain flowed south, fertilizer passed through US ports, rail, terminals, logistics and access were embedded deep inside American systems. That dependency was treated as permanent. Then came renewed tariff threats, pressure on fertilizer imports, and talk of punitive rates that could reach 25% on key agricultural flows. On paper, it looked like leverage, a reminder of who controlled the routes. But that assumption missed something important. The real shift did not begin in Washington. It did not begin at a border crossing or a customs desk. It began with a question asked inside Canada. In March 2025, speaking directly to prairie farmers, Mark Carney raised an issue that had long gone unchallenged. Why, he asked, was Canadian fertilizer still moving through American ports when a shorter, cheaper route to Europe already existed? Why were farmers in Saskatchewan paying US logistics firms while a Canadian Arctic port sat idle? The question was not framed as criticism, it was framed as logic. Canada grows the wheat in Saskatchewan, it produces canola in Alberta, it dominates global potash production, ranking as the world's largest exporter and controlling roughly a third of global supply. Canada is also the third largest wheat exporter globally. Yet despite that strength, the movement of those products had long been outsourced. Grain and fertilizer were routinely sent south first, handed off to American rail networks, terminals, and fee structures before continuing overseas. For decades, that system was accepted as inefficient but unavoidable. Vancouver was congested but familiar. Eastern routes were longer and complex. Northern routes existed mostly on paper. When tariff threats returned, dependency stopped being an inconvenience and became a risk. The scale of what was at stake rarely receives public attention. Potash alone tells the story. Canada accounts for roughly 32% of global potash production and more than 40% of exports, with an estimated 1.1 billion tonnes still underground. Potash is not optional. It is a cornerstone of modern fertilizer. Without it, global crop yields fall sharply. Nitrogen fertilizers supported by potash help sustain food production for nearly half of the world's population. That gives Canadian mines an outsized role in global food security, whether acknowledged or not. Grain tells a similar story at a different scale. Canada exports roughly 27 million tonnes of wheat annually to more than 80 countries, generating over $11 billion in revenue. Canadian wheat is valued for consistency and protein content, making it a preferred choice in premium markets. Add canola, barley, oats, lentils, peas, and specialty crops, and Canada emerges as a central pillar of global food supply. In 2023, total agricultural exports surpassed $99 billion, with steady growth projected year over year. Western grain relied heavily on Vancouver, a port strained by congestion, rising costs, and limited flexibility. Fertilizer followed similar paths, entering US logistics systems before reaching overseas buyers. At every step, fees accumulated. Rail charges, terminal fees, logistics premiums. American companies profited without growing a single crop or extracting a single ton of potash. Dependency was profitable, just not for Canada. That dependency became impossible to ignore once political risk entered the equation. When tariff threats resurfaced, it became clear that American control over logistics translated into American influence over outcomes. The issue was no longer about cost efficiency. It was about sovereignty. A glance at the map revealed what had been overlooked. The port of Churchill, a deep-water Arctic gateway on Hudson Bay, cuts thousands of kilometres off the route to Europe compared to shipping through Vancouver or US terminals. Built in the 1930s, rail-connected and positioned as Canada's northern gateway, it should have been transformational. For decades, the port suffered from underinvestment, limited seasonal use, and political indifference. In 1997, it and its 1,300-kilometre rail line were sold to a private American firm for $1. Maintenance lagged, cargo volumes dwindled. When flooding damaged the rail line in 2017, the owner walked away. The port fell silent. Churchill itself was effectively cut off. In March 2025, Genesis Fertilizers, a Saskatchewan-based company planning a major nitrogen fertilizer facility, announced a partnership with Arctic Gateway Group. The plan was straightforward. Phosphate and ammonium sulfate would be imported through Churchill. Fertilizer products would be exported the same way. American infrastructure would be removed from the chain entirely. The decision was not ideological, it was economic. Genesis projected annual production of roughly 1 million tons of fertilizer, requiring about 300,000 tons of phosphate imports. Historically, that phosphate entered Canada through US ports. Under the new model, it would arrive via Hudson Bay. The route from Saskatchewan to Europe through Churchill is significantly shorter than routes looping through Vancouver or passing through the Panama Canal. Fewer miles meant lower costs, faster delivery, and reduced exposure to political interference. Once one company demonstrated that the economics worked, the implications spread. Saskatchewan's fertilizer sector alone is worth billions annually. If Genesis could anchor its operations around Churchill, others could follow. Fertilizer, however, was only the opening move. Grain represented the larger shift. Canada ships nearly 29 million tons of grain annually through Vancouver. Churchill's historical throughput was modest by comparison. The objective was not replacement. It was diversification and future capture. The Port of Churchill Plus project emerged to expand capacity through modern grain handling, increased storage, upgraded loading equipment, and improved rail reliability. With sufficient icebreaker support, the shipping season could extend well beyond its traditional limits. For European markets, the advantage is clear. Routing grain through Churchill cuts approximately 6 days off the journey compared to Vancouver. That translates into lower logistics costs, reduced spoilage risk, better timing, and greater predictability. More importantly, it removes American involvement entirely. Canadian grain grown by Canadian farmers, moved on Canadian rail, shipped through a Canadian port, delivered directly overseas. This is where the often cited $780 billion figure enters the discussion. It does not represent current annual trade. It reflects projected trade that could move through Churchill over the next decade if planned capacity comes online. Saskatchewan's potash exports alone generate roughly $5.5 billion annually. Shift even a portion northward over 10 years, and the total grows rapidly. Add grain exports, fertilizer flows, critical minerals, and potential energy shipments, and the cumulative value approaches the $700 to $800 billion range. The United States would not lose all involvement overnight. Traditional routes will continue to serve certain markets, but American ports, railways, and logistics firms that have benefited from Canadian dependency for generations stand to lose a meaningful share of business. More importantly, they lose leverage. Infrastructure shapes behavior. Skepticism remains after decades of stalled plans. What distinguishes the current moment is alignment. Shipping economics favor shorter routes. Congestion penalizes traditional ports. Arctic access improves each year. Private companies are committing capital. Provincial governments see diversification as essential. The federal government has committed long-term funding, signaling national priority rather than experimentation. This shift extends beyond agriculture. Trade that flows through assets you own creates leverage. Canada is not rejecting trade with the United States. It is reclaiming optionality. A port once dismissed as a relic is now reshaping how Canadian grain and fertilizer reach the world, quietly, structurally, and in ways that leave little room for reversal. If this analysis gave you a clearer view of how power actually moves through infrastructure, make sure to subscribe and turn on notifications. More deep dive breakdowns are coming.